How do you calculate a lack of marketability discount? Have you ever wondered how the value of a business interest can change when it comes to selling it? Today, we will discuss the lack of marketability discount and how to calculate it, especially in the context of estate planning and minimizing estate taxes. First, let's clarify what a lack of marketability discount is. This discount applies to interests in privately held businesses. These interests are often harder to sell than shares of public companies. The discount reflects the challenges and time involved in selling such interests. Several factors can influence the size of this discount. Transfer restrictions are one major factor. If there are legal or contractual limits on transferring shares, the discount will likely be higher. Company performance is another aspect. If a business is not profitable or lacks future earnings potential, the perceived risk increases, leading to a higher discount. Liquidity also plays a role. Companies with substantial cash reserves or easily marketable securities usually have a lower discount. Lastly, market conditions can impact the marketability of a business interest. Economic trends and industry-specific factors can either increase or decrease the discount. Now, let's talk about how to calculate the lack of marketability discount. There are several methodologies you can use. Quantitative methodologies involve using empirical data and models. One common method is analyzing restricted stock studies. These studies look at discounts applied to stocks that cannot be immediately resold. The discounts observed can help estimate the lack of marketability discount. Another method is pre-initial public offering studies. These studies analyze discounts applied to stocks before they become publicly traded. The data from these studies can also inform your calculations. Some professionals use option pricing models to estimate the discount. These models take into account the time to liquidity and the volatility of the underlying asset. In estate planning, accurately calculating the lack of marketability discount can significantly reduce estate tax liability. By applying this discount, the taxable value of a business interest can be lowered. This is particularly useful when gifting or transferring ownership interests to family members. Creating defensible valuations is essential. Understanding how to calculate the lack of marketability discount helps avoid disputes with tax authorities. Given the complexity of these calculations, seeking professional guidance from appraisers and legal experts is advisable. In summary, calculating a lack of marketability discount involves understanding various influencing factors and applying the right methodologies. This calculation is vital for effective estate planning and minimizing estate taxes.